Hello, and welcome to Boni's Life, the channel where we cut through the noise to bring you the insights that matter. Today, we're diving into a story that strikes at the very heart of our economic stability. A high-stakes drama unfolding between the White House and the Federal Reserve. Just last night, Fed Chair Jerome Powell took the unprecedented step of releasing a video statement confirming that the Department of Justice, under the Trump administration, is not just investigating him, but threatening a criminal indictment. This isn't just a political headline, it's a seismic event with the potential to rock global markets to their core. The administration claims this is about cost overruns on a building renovation, but Powell, in his own words, calls that a pretext. He alleges this is a direct consequence of the Fed refusing to bow to political pressure on interest rates. So, what's really going on here? Is this a legitimate investigation, or is it an unprecedented political assault on the independence of the world's most powerful central bank? In this episode, we will unpack the entire situation. We'll analyze Powell's dramatic statement, place this conflict in its shocking historical context by looking at past presidents who went to war with the Fed, and examine the other legal battles the Trump administration is waging against Federal Reserve governors. And most importantly for us as traders and investors, we will conduct a deep and thorough analysis of the market's reaction. We'll look at the immediate fallout in both crypto and traditional markets, examining everything from Bitcoin's price action to the S&P 500, using key indicators like open interest, liquidations, and the Fear and Greed Index. We'll identify the technical setups you need to be watching and outline the global events on the horizon that could amplify this volatility. Finally, we'll equip you with concrete trading strategies. Whether you're a beginner just starting out or a seasoned pro managing a complex portfolio, this is a moment of profound uncertainty, but uncertainty creates opportunity. Let's get into it. First, let's break down the event that triggered this firestorm. On Friday, January 10th, 2026, the Federal Reserve was served with grand jury subpoenas. In his video statement, a visibly resolute Jerome Powell explained that these subpoenas carry the threat of a criminal indictment related to his testimony before Congress last June. That testimony, on the surface, was about a multi-year $2.5 billion project to renovate the Fed's historic buildings in Washington. The White House had been criticizing this project for months, calling it overly costly and ostentatious. This culminated in President Trump himself taking a highly unusual tour of the construction site back in July 2025, with Powell acting as his guide. The official line from the Justice Department is that they are simply investigating a potential abuse of taxpayer dollars. However, Chair Powell's statement paints a very different picture. He stated, and I quote directly, "This new threat is not about my testimony last June or about the renovation of the Federal Reserve buildings. Those are pretexts. The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the president." This is an explosive accusation. The head of the central bank is publicly declaring that the nation's highest law enforcement body is being used as a tool of political intimidation to influence monetary policy. He is, in effect, saying this is retaliation for not cutting interest rates as far and as fast as President Trump has demanded. This isn't the first time the administration has targeted a member of the Federal Open Market Committee, or FOMC. Right now, a landmark case, Trump v. Cook, is pending before the Supreme Court. In August 2025, President Trump attempted to fire Federal Reserve Governor Lisa Cook, citing unproven allegations of mortgage fraud from before she took office. The case, which will be heard on January 21st, revolves around the president's power to remove a Fed governor. While the law states a governor can only be removed for cause, the administration is challenging the very constitutionality of that restriction, arguing it infringes on presidential power. The outcome of this case will have monumental implications for the Fed's future independence, and the investigation into Powell is seen by many as the second front in this war. This kind of open warfare between a president and the Federal Reserve might seem shocking, but history provides a few chilling precedents. And the lesson from those conflicts is stark. When politics compromise the Fed's independence, the economy pays a heavy price, often for years to come. The most infamous example is the relationship between President Richard Nixon and his Fed Chair Arthur Burns in the early 1970s. Nixon, desperate to ensure a booming economy for his 1972 re-election campaign, relentlessly pressured Burns to keep interest rates low and the money supply loose. The recently released Nixon tapes are filled with conversations where the president bullies and cajoles the Fed chair. Unlike Powell, Burns ultimately caved to the pressure. He was a friend of Nixon's, and the political heat was immense. The Fed kept the monetary spigots open, and Nixon won his re-election in a landslide. But the victory was short-lived. The expansionary policy, in an already inflationary environment, unleashed a devastating economic storm. The result was the Great Inflation of the 1970s, a painful decade of stagflation, where the country suffered from both high inflation and high unemployment simultaneously. It took nearly a decade and the iron will of a later Fed chair, Paul Volcker, who jacked up interest rates to a staggering 20% in 1981, to finally break the back of that inflation. The cost of that correction was two painful recessions. Before Nixon, there was President Lyndon B. Johnson's legendary confrontation with Fed Chair William McChesney Martin in 1965. Johnson, funding both the Vietnam War and his Great Society domestic programs, was furious when Martin raised interest rates to combat rising inflation. In a now famous incident, Johnson summoned Martin to his Texas ranch and physically shoved him around, screaming, "You've got me in a position where you can run a rapier into me, and you've done it." Martin, to his credit, stood his ground. He told the president that the Federal Reserve Act gave the board final responsibility for interest rates. While Martin won the battle, he arguably lost the war. The political pressure from the White House remained intense, and the Fed's policies in the following years were often inconsistent. Inflation, which had averaged just 1.5% for the prior 13 years, began its steady climb, hitting nearly 6% by 1969 and setting the stage for the disaster of the 1970s. It took over 15 years to correct the damage that began with that political interference. These historical episodes are not just academic footnotes, they are dire warnings. A 2024 study that analyzed political pressure on the Fed from 1933 to 2016 came to a stunning conclusion. The researchers found that exerting political pressure just half as intense as what Nixon applied to Burns over a 6-month period leads to a permanent increase in the U.S. price level of more than 8% with no significant benefit to real GDP. The lesson is clear. Political pressure on the Fed doesn't create growth, it creates inflation. So, how have the markets, the ultimate arbiters of economic confidence, reacted to this unprecedented news? The response was immediate and followed the classic playbook for an attack on a major democratic institution. There was a clear flight to safety and a pricing in of significant new risk. Let's start with the traditional markets. As the news broke Sunday night, U.S. stock futures immediately tumbled. The dollar fell broadly against other major currencies, and investors rushed into the traditional safe haven of U.S. Treasury bonds, causing their prices to rally. But the most dramatic move was in gold, which jumped to a record high. As one analyst from Wilson Asset Management noted, gold has strengthened, equities have wobbled, and the yield curve has steepened. These moves have been broadly consistent with the playbook for an attack on the Fed's independence. Now let's turn to the crypto markets. The reaction here has been more complex, reflecting the unique nature of this asset class. Looking at the data from CoinGecko, the total crypto market cap saw a slight dip, hovering around $3.18 trillion, a modest 0.3% decrease in the 24 hours following the news. This might seem muted, but we need to look deeper. Turning to CoinGlass for derivatives data, we see a more telling story. The Fear and Greed Index has plunged to a score of 26, firmly in the fear category. This indicates a significant shift in market sentiment, away from the greed that has recently characterized the market. We've also seen a spike in liquidations, with over $211 million liquidated in the last 24 hours, a jump of over 200%. This shows that the sudden volatility caught many leverage traders off guard, forcing them out of their positions. Open interest, which represents the total number of outstanding derivative contracts, has decreased by 1.2% to $138 billion. For Bitcoin specifically, open interest is at $61.2 billion, down nearly 1% in 24 hours. This suggests that some capital is flowing out of the derivatives market, a sign of de-risking. Interestingly, the 24-hour long-short ratio is nearly balanced at 49.6% long to 50.4% short, indicating deep division and uncertainty among traders about the next directional move. What does this all mean? The crypto market is trying to decide if this crisis is bullish or bearish for Bitcoin. The bullish argument is that an attack on the Fed's credibility and the potential for politically driven inflation reinforces Bitcoin's core value proposition as a decentralized, non-sovereign store of value, a true digital gold. The bearish argument is that this level of political instability in the world's largest economy creates a risk-off environment, where investors flee all assets perceived as risky, including crypto, in favor of cash or short-term government bonds. For now, the market is caught in a tense equilibrium, waiting for the next shoe to drop. This institutional crisis couldn't have come at a more sensitive time. The week ahead is a minefield of critical economic data and events that will now be viewed through this new lens of political uncertainty. All eyes will be on the CPI inflation data, set to be released on Tuesday. The consensus forecast is for a slight moderation in the annual inflation rate to 2.7%. If the number comes in hotter than expected, it will put the Fed in an even more difficult position. A hot CPI print would normally demand a hawkish stance, but with the threat of a criminal indictment hanging over his head, will Powell be perceived as having the freedom to act? Any hesitation could be seen as the Fed caving to pressure, potentially unanchoring inflation expectations and forcing the market to price in a political risk premium on the dollar. Beyond the CPI, we have a slew of Fed speakers scheduled throughout the week, including Bostic, Bakin, Williams, and Musalem. Their every word will be scrutinized. Will they present a united front behind their chairman? Any hint of division within the FOMC could send shockwaves through the market. We also have the Producer Price Index, PPI, and retail sales data on Wednesday, which will give us a clearer picture of the economy's underlying strength. Looming over all of this are two major events. First, the Supreme Court hearing for the Trump vs. Cook case on January 21st. A ruling that expands the president's power to fire Fed governors would be a body blow to the central bank's independence. Second, the next official FOMC meeting is on January 27th and 28th. While no rate change is expected, the press conference will be one of the most closely watched in history. In this environment, having a clear strategy is paramount. Let's outline some potential scenarios and how different types of traders can approach them. In the first scenario, which we'll call escalation and crisis, new damaging information emerges, political rhetoric intensifies, or key Fed officials resign in protest. This would likely trigger a major risk-off event. The dollar could weaken significantly, gold would likely soar, and both stock and crypto markets would probably see a sharp sell-off as investors flee to cash. The fire and greed index would plummet deeper into extreme fear. In the second scenario, de-escalation and stalemate, the political pressure continues, but no new major actions are taken. The situation remains a tense standoff. Markets would likely remain highly volatile and range-bound, reacting nervously to every headline and rumor. We would see capital rotating between risk-on and risk-off assets, creating choppy price action. The third scenario is resolution and reassurance. This is the most optimistic scenario, where the legal threats are withdrawn and there is a clear bipartisan affirmation of the Fed's independence. This would likely trigger a significant relief rally across all risk assets, including stocks and crypto. The dollar would likely strengthen and gold might pull back from its highs. Now, let's tailor strategies for our different trader profiles. For the beginner trader, your primary goal is capital preservation. This is not the time for aggressive speculative bets. Avoid using high leverage. If you are a long-term believer in your chosen assets, consider this volatility as a potential dollar-cost averaging opportunity on significant dips. Focus on the largest, most liquid assets like Bitcoin and Ethereum. Stay informed, but don't let the daily noise panic you into making emotional decisions. Your best move is often to make no move at all and wait for the storm to pass. For the intermediate or swing trader, this is a market for the nimble. Tight stop losses are non-negotiable. Pay close attention to key technical levels. For Bitcoin, the immediate support to watch is the $88,000 level. A break below that could open the door to a test of the $85,000 support zone. To the upside, a reclaim of the $92,500 level would be the first sign of strength, with the major hurdle being the psychological $100,000 mark. Be prepared to take profits quickly and don't get married to a position. Trading the ranges rather than chasing breakouts will likely be the more profitable strategy in this choppy environment. For the advanced or long-term investor, this is a time to think about portfolio allocation and hedging. The core thesis of this event is the potential debasement of the dollar and the erosion of institutional trust. This makes a compelling case for assets that act as a hedge against these risks. Gold has already proven its mettle. For those with a higher risk tolerance, this could be a pivotal moment for Bitcoin's narrative as digital gold. Consider the relative value plays. If faith in the central bank is shaken, assets with hard-coded, predictable monetary policies become more attractive. This is also a time to look at option strategies to hedge your portfolio against downside risk or to position for a spike in volatility. We are witnessing a profound test of America's economic and political institutions. The independence of the Federal Reserve, a principle that has been the bedrock of U.S. economic stability for over 70 years, is under direct and open assault. The historical precedents are clear and deeply concerning, showing a direct link between political interference and subsequent economic pain, particularly runaway inflation. The market's initial reaction of fear and uncertainty is entirely rational. As traders and investors, we must navigate this period with caution, discipline, and a clear understanding of the risks and opportunities at play. The coming days and weeks will be critical. The resolution of this conflict or lack thereof will set the course for the markets, not just for the rest of this year, but potentially for the decade to come. Stay sharp, stay informed, and manage your risk. We'll be tracking every development right here. Thanks for watching Boni's Life.